Hello, I'm Jim Cross from Village Missions. I'm here today to talk to you about how to avoid big tax bites on the sale of appreciated assets. We have charitable tools to help you avoid tax and to create income for your family. We're here to do a short series of videos to help you be more tax savvy about your giving so that you can do more for your church and the ministries that you care about. This is Tax Savvy Giving. The technique that I want to talk to you about today boils down to one tip that I want you to keep in mind. This is the big idea. Don't sell, pay tax, and then give. Instead, give first and then sell. When you give the property before the sale occurs, you will avoid tax and provide more money for your family and your favorite ministries. And you'll see what I mean when we're done. Also, please plan first by involving your tax advisor. A good tax planner will save you money. When we work with generous givers, we always encourage them to involve their own advisors. I've heard from tax advisors who lament that their clients don't call them during the year. Sometimes clients will do things on their own and then they'll go to see the tax advisor at tax time and the tax advisor will say, "Has anything changed?" And they'll say, "Nope, nothing's changed." And then they'll get into it and they'll get down to Schedule E and the tax advisor will ask, "Well, where's the income for this property?" And they'll say, "Oh, I sold that." Well, you need to talk to your tax advisor during the year. I remember when I was a college student preparing tax returns for a CPA, I did this one return for a real estate investor who sold a property and had a huge tax bill. We thought, oh no, this is bad. No one wanted to take this guy's calls, and the partner ended up delivering the bad news. They were old friends from way back, and it turned out okay, but the partner would lament and say, "Oh, he never listens to me." So please involve your advisor and plan first. Don't wait until tax time when you see your advisor to drop off your stuff, because if you've made a big move with your stuff, they can't fix it at that point. The damage is already done. So planned giving techniques work with all kinds of appreciated property, but today I want to talk to those landlords specifically. It takes a special kind of person to be a successful landlord. You need to be able to read people, you need to be tough yet fair, you need to know real estate law, and you also need to be a handyman. And it can become time-consuming, all-consuming. Rental properties are an excellent way to generate income. It's passive income, it's not subject to Social Security tax like wages are. And the depreciation on a rental property can offset a substantial amount of tax over the depreciable life of the property. Yet there comes a time when you want to get out of the landlord business. If you're like me, you have no problem getting under the sink to repair a pipe, but getting back up is getting more difficult. You want to enjoy retirement and get that time back, but these rental properties have a hold on you. Randy Alcorn, in his book, The Treasure Principle, talks about how all objects have this physical property called mass. The more mass an object has, the greater its weight will be. The greater the mass, the greater the hold that mass exerts. The more things we own, the more they grip us, setting us in orbit around them. Finally, like a black hole, they suck us in. You think you own your stuff, but in reality, your stuff owns you. Randy Alcorn goes on to say that giving changes all that. It breaks us out of the orbit around our possessions. We escape their gravity, entering a new orbit around our treasures in heaven. So I have an offer for you. If you contact me, I would like to give you a copy of the Treasure Principle. This is a great little book that will help you discover the joy of giving. So, you'd like to get out of the landlord business, but you know if you sell, you're going to face a huge tax bill. If you talk to a tax advisor, they typically will give you 3 common techniques to avoid tax. The first technique is to move back into your rental property and make it your principal residence for 2 years. You may be thinking, I like where I'm at, I want to stay put, and by the way, I moved for a reason, I'm done shoveling snow. So there's that option. The second technique is to do a 1031 exchange. A 1031 exchange can be attractive, but it usually only works if you're liquid and you plan to eventually convert the replacement property into your primary residence, because you must reinvest at an equal or greater amount. You cannot cash out any portion of the proceeds of the sale of your property. A 1031 may not work for you if you rely on that rental income cash flow, or you need to access some of the cash from the proceeds of the sale. The third technique is to harvest investment losses by selling your losers to offset the winners. This can work in years when the market is down, but if you've held your property for a couple of decades or more, you could be trying to scrounge up a lot of losses. And it wouldn't work following a year like 2017, where the stock market restored in 1 year what the low costs had destroyed over the past decade. There are not a lot of losers. You'd have to own a lot of General Electric to offset the gains from selling a rental property that you've owned for 2 decades. So, let's look at an example. We have our friends, Bill and Betty, who purchased a 3-bed, 2-bath rancher as an investment in 1998 for $125,000. They've taken depreciation on the property, and their current cost basis is $32,000. The current market value is $250,000. If they sell outright, they will face a capital gains tax of $18,750. This is an example of what happens when the donor sells first and then gives second. But what if we could avoid that capital gains tax and do something for our church and our favorite charities? One technique is to give the property in exchange for a charitable gift annuity. The essence of a charitable gift annuity is that the donor makes a gift to charity, and in return, the charity makes payments to the donor for life. Charitable gift annuities are simple yet powerful and can be used in a variety of situations. Like more expensive and complicated giving vehicles like charitable trusts, a charitable gift annuity provides a stream of income to the donor and an immediate tax deduction. And when the annuity is purchased with appreciated assets, capital gains are deferred. So let's look at what Bill and Betty could do with a charitable gift annuity. Here, Bill and Betty have made a gift of the home to the charity first. The charity then sells or uses the home as they see fit. The gift amount is determined by the fair market value at the date of the gift. So I have set their ages at 68 and 66 for purposes of this illustration. Because they gave the house first, the entire $250,000 goes into the annuity. And this is how the annuity will stack up. Bill and Betty will receive a stream of income for their lifetimes equal to 4.4% based on their ages. If you're a little older, you will see the effective payout rate going up a little bit higher because you have fewer years to pay over your lifetime. They receive an immediate charitable tax deduction of $81,445, and that charitable tax deduction can be used over any number of years until it's expended. 65% of the payments will not be reportable as ordinary income on their tax return. If you look at the breakdown, you will see that on an annual basis, only $3,762 will be reported as ordinary income. $6,308 will be paid as capital gains, and $929 will be paid tax-free. Now, you know that based on the capital gains thresholds, it's not likely that Bill and Betty are going to pay income tax on that $6,308 either. So hypothetically, you're talking about over $7,200 of tax-free income. Bill and Betty will receive $11,000 a year in annuity payments. It's interesting to note that the monthly annuity of $916 could be equivalent to a rent payment. That sounds a lot like a rent payment. Depending on where in the country you live, $916 may be equivalent to what you're getting in rent. When you factor in the cost of property taxes and insurance and tenants, a charitable gift annuity may actually be a viable option for you. Now, if you have more questions about using real estate in your planned giving, please feel free to contact us. We do a lot of work with National Christian Foundation because they share our kingdom values, and they have a page on their website where you can learn more about how to be tax savvy giving with real estate. I'd encourage you to go and take a look at that as well. And when you think of giving, I encourage you to not just reach for the checkbook, but to look at all of your assets and consider how you can do it in a tax-savvy way. Today we talked about just one way to use the benefits of the tax law to avoid tax, provide a stream of income for your family, and bless the churches and ministries that you care about. If you have any questions about how to be a tax-savvy giver, please get in touch. We are honored to help you however we can. And remember, I'm just going to put our contact information up on the screen here. Remember, if you'd like a copy of Treasure Principle, it's a great little book. I recommend it. It will change your life. I have learned so much from Randy Alcorn over the years, and I'd love to be able to share this with you. So thank you for listening, and I look forward to talking to you again. Thank you.